A company announces a dividend and you decide you want it. So you buy the stock. But here's the problem: buying the stock isn't automatically enough. There are specific dates you need to understand if you want to know whether you are eligible for the dividend or not. Now, three of them are especially very important. The first is ex-dividend date, second is the record date, and third is the payment date. Now, let's make them understand incredibly simple. So, hello everyone, and welcome back to Suujish Dividends and to another episode of Dividend Diaries. In our previous episode, we learned about the dividend payout ratio and why sustainability matters. Today, we are moving from understanding dividends to understanding how dividend eligibility actually works. Let's get started. So, when a company declares a dividend, there are generally four dates you may come across. The first one is declaration date, second is the ex-dividend date, third is the record date, and the fourth one is the payment date. The declaration date is when the company officially announces the dividend. The ex-dividend date is the date from which a new buyer generally won't be entitled to that upcoming dividend. The record date is when the company checks its shareholder records to determine who is entitled to receive that dividend. And finally, the payment date is when the dividend is actually paid to the eligible shareholders. Now, let's start with the declaration date. This is when the company announces something like, we are declaring a dividend of rupees 5 per share. The company will also announce the relevant dates and other details as well. But remember, just because a dividend has been announced doesn't mean you can buy the stock at any point of time and still receive it. Now comes the most important date for a new investor, the ex-dividend date. Think of the ex-dividend date as the cutoff point for a new purchase to qualify for that particular dividend. If you purchase the shares on or after the ex-dividend date, you generally won't receive that upcoming dividend. To be eligible for that dividend, you generally need to purchase the shares before the ex-dividend date, subject to the applicable market settlement rules. That's why simply seeing a dividend announcement and buying a stock afterward isn't enough. Now, next is the record date. On this date, the company looks at its records and determines which shareholders are entitled to the dividend. You may wonder, if the record date determines eligibility, why is the ex-dividend date so important? That's because the stock market has a settlement process. Your purchase doesn't necessarily become an official shareholder record instantly. That's why the ex-dividend date works together with the record date to determine eligibility. In a simple analogy, think of it like registering for an event. The record date is when the organizer checks the final guest list, and the ex-dividend date is effectively the cutoff that determines whether your purchase makes into that list or not. So now, finally, we have the payment date. This is the easiest one. It's the date on which the dividend is actually paid to the eligible shareholders. So don't confuse eligibility with payment. You may qualify for the dividend today, but the money could arrive weeks later depending on the company's payment schedule. So let's put everything together with a simple example. Now imagine a company ABC announces a dividend of rupees 10 per share. The company announces ex-dividend date as June 10, record date as June 11, and payment date as June 25. If you are eligible under the applicable settlement rules, and buy the shares before the ex-dividend date, you can qualify for that dividend. But if you buy the shares on June 10, the ex-dividend date, you generally won't receive that particular dividend. And if you're eligible, you don't necessarily receive the money on the X date. You wait until the payment date. That's how it works. And now, here's an important lesson. Don't buy a stock simply because its ex-dividend date is approaching. Remember what we discussed in episode 4? A dividend yield isn't everything. And in episode 5, we learned that a dividend also needs to be sustainable. So buying a poor quality company just to collect one dividend can be a terrible long-term investment decision. As a dividend investor, we are looking at the business, not just the next dividend. So what are the key takeaways from today's video? Let's have a quick recap. The first is declaration date. The company announces the dividend. The second is the ex-dividend date, the key cutoff date for new purchases to qualify for the upcoming dividend. The third is the record date. The company determines eligible shareholders according to its records. And the fourth is the payment date. The dividend is actually paid. And remember, don't chase dividends. Instead, build quality ownerships. So, in our next episode, we are going to answer another question that every beginner eventually asks. How do I actually choose a good dividend stock? We'll talk about the factors I look at before considering a dividend paying company for a long-term portfolio. If you are enjoying Dividend Diaries by now, make sure you subscribe to Suujish Dividends and join me every Sunday at 10 a.m. Until next time, remember one thing: we are building wealth one dividend at a time.